think I remember my first proper dividend payment from buying shares in a company I used to work for about 7 or 8 years ago. I didn't really understand the whole process, but that year they paid out a nice amount of cash and also a special dividend as well, so I saw 2 amounts of money actually paid into my account.
Don't let anyone have it. Take it straight home. You understand?
I actually can't remember if I invested the money or not, but that's not important, because what actually is important today is trying to answer that question: is dividend investing good for beginners who want to start making some money in the stock market? Let's first look at some of the good sides before we tackle some of the not so good parts, which a lot of people often complain about. Yes, people do complain about getting paid money, but they do have a point, so let's work through them all together, and hopefully by the end you'll be in a much better position to understand dividends than I was all those years ago. Just as a reminder, in really simple terms, dividends are payments from businesses back to their shareholders, and most often delivered to you in cash, and that payment's based on how many shares of the company that you might hold at any given time. Many companies pay dividends. In fact, most big companies pay some kind of dividends. You can see if a company pays a dividend by looking for what's known as a dividend yield, which any good stock website will give to you. I quite like using this one here, but you can use anything you like, whether that's Seeking Alpha, Yahoo Finance, or even any kind of trading app that you like using. And you can also find it in the financial statements too. So if you go over to the cash flow statement and you scroll all the way down to a line that says dividends paid, you'll be able to see the exact amount of cash that the company's paid out that year in total. So in this example on the screen, we can see that Coca-Cola has paid out $7.25 billion in dividends, and that was for the year of 2021. And if you look closer, you can see that they've paid out dividends for many, many, many years. Actually, for more than 50 years. Probably one of the best things about dividends is that as a shareholder, you get back real hard money that you're able to do with whatever you like. It's not like when the value of your house goes up that it's just a number on paper. Getting paid dividends is real cash today in your pocket. I think it's worth remembering that when you buy shares, you become a business owner. Even though it might only be a really small amount, you're now entitled to those profits of that business. And one way of you getting your hands on them is by literally getting physically paid them straight from the company. So a big tick in the box there. There's no simpler way to deliver profits back to you. Second up, being paid a dividend allows you as a shareholder a choice of what to do with that money. The business is basically saying, here's your slice of the profits. Go ahead and choose what you think is best to do with it, rather than, on the other hand, them choosing to spend it on what they think is best. By getting paid a dividend, you're completely free to spend the cash on whatever you like. You could even treat yourself to a full tank of fuel at the petrol station, or probably one of the most popular things to do with dividends is get them reinvested back into the same company and just buy some more shares. This is one of the most powerful ways to grow your investment portfolio, and it will really help get that compounding interest working for you, which really starts to work over the really long run. Next, a point that often gets overlooked, but one that I really appreciate a little bit more now: dividends help provide us with a little bit of a reward and keep us motivated as investors. Personally, I'm not too concerned with this, but I have heard this from a number of investors that seeing regular payments into their investment account has really helped them remain consistent and keep them motivated. Lots of people like to track their dividend payments, get them reinvested back into their portfolios, and then watch them grow once a dividend comes around the next time. It's almost like going to the gym and working on your biceps, but you don't see any improvements until you've been working out for 10 years. I think you'd be pretty annoyed and end up giving up long before the 10 years was finished. That's almost like how traditional investing can sometimes feel, because you don't think of the benefits and the number is just something you see on a screen or on paper. But with dividend investing, you get to see real returns pretty regularly, and those returns, no matter how small they start off at, end up being the motivating factor that you need to keep going. So what I'm trying to say is that dividend investing is like having really good lighting in the bathroom when you're trying to show off the pump that you got from a workout. I think you get the idea. And finally on the list for good parts of dividend investing, after that poor attempt at some weird comparison to going to the gym, companies that pay a dividend have proven themselves over the long term to actually deliver better returns. This point sounds strange when you first say it, because you assume that a company paying a dividend is probably some big company that isn't growing anymore and has nothing left to do with the cash, but the reality is a little different. If you have a look at the data, you'll see that companies who have paid out a dividend have actually performed better than the ones who don't. See here on this chart showing how $100 invested in the S&P 500 would have grown all the way back in 1973. If you would have invested in every company equally, your account would have grown to $4,744. If you would have invested into just stocks that don't pay a dividend, you would have done even worse with $989. However, check out the performance of the lines at the top. The top two lines show the difference that investing into dividend payers and dividend initiators would have done for your gains. So initiators is just a fancy way of saying those companies who started paying a dividend. Your $100 investment would have grown all the way to $14,405 if you would have had all of those dividend paying stocks. Not bad considering that you might have thought that only growth stocks who reinvest everything back into their business are the ones actually doing the growing. Now let's talk about some of the criticisms, because dividends aren't all plain sailing. There are definitely some major downsides that we need to talk about. First up, everyone's favourite topic, taxes. Now, when you get paid a dividend, remember that it becomes part of your income. What that means is that you do need to work out if you have to pay taxes on it. Now, lucky for us in the UK and other countries, there is a free allowance that you can receive until even if you need to consider paying any tax at all. At the current time in this tax year, you're allowed to receive £2,000 worth of dividends tax-free in the UK. After that point, you may have to pay tax on the dividends. And I say the word may have to because if you're using a stocks and shares ISA for your investments, you're free from any tax on dividends. So this is another reminder to make the most of that type of account. Outside of this, if you aren't using an ISA and make over £2,000 a year on dividends, the amount you pay depends on how much you earn and is based on the different income bands. And it could mean anything from 8.5% tax all the way up to 39.35%. But either way, this might be a good time to consult a professional, as I'm certainly not one of those. Leading on from that point, next up, many people might be critical of a business paying out dividends because rather than create them a headache for their taxes, they would much rather the company took the cash and bought back some of their own shares. You might have heard of this before, but a company can buy its own shares and then effectively remove them from the market, or maybe even use them to give to employees as part of some kind of incentive plan. In basic terms, if a company buys back its own shares, you as a shareholder gain a larger share of the business, and it's easy to explain if we use a quick example. Say there are 100 shares of a business and they each cost $1, so the company would be worth in total $100. They were going to pay out a dividend of 10 cents per share this year because they had such a good year in business. Let's say they sold toilet roll or something like that. So you own 10 shares of the company worth $10 in total. You would have received $1 worth of dividends, 10 lots worth of 10 cents, nice and simple. But instead of paying a dividend, the company said, we're going to buy back shares instead. Here's what happens. With that money that was due to be used to pay for the dividends, which would total $10, 100 lots of 10 cents, they would now be able to buy back $10 of their own shares and remove them from the market. This now means that the company has only 90 shares, but it's still worth $100. All they've done is make each share worth more by giving you a larger share of that business. And they haven't caused you any stress with your tax accountant because no dividends were paid. Many companies do this, and it's a good way to grow your earnings per share, even if you actually didn't make any more sales that year. Selling toilet rolls, though, can be a very valuable business. Just quickly, while you're still trying to figure out how I've managed to explain things so poorly, if you are enjoying the video, please drop me a like and consider subscribing as well. It really helps out smaller channels like mine get to more people in the big bad world of YouTube. Now, back to those dividends. This point might be obvious, but as I've said before on the channel, dividends aren't just free money, they're paid out from the company from their cash, which they hopefully made in profits. If we go back to that first example we spoke about with Coca-Cola, remember how they paid out $7.25 billion worth of dividends last year? Well, once they do that, the company reduces in value as by, you guessed it, $7.25 billion. The share price will likely drop to reflect this on the stock market. And then leading on from this point, another one which might seem obvious but still worth noting is that by paying out the dividend as cash, the company won't have that money to reinvest back into their business. They could use it to pay down any long-term debt, to invest in new machinery, or even look to acquire another business entirely. But by paying it out as a dividend, the business is almost saying that they don't have anything better to spend the money on. You can argue whether it's a good or a bad thing, it all depends on your point of view, but plenty of investors won't be happy receiving cash. They'd much rather just see the business grow. Okay, let's talk about the elephant in the room with dividends, something that doesn't get mentioned very often. Dividends are not guaranteed to get paid in any way and can be cut at any point from the company who's paying them out. Sure, if a company's been paying out a dividend for 50 years, it's very unlikely to cut a payment, and most likely that will continue, but many companies have and will no doubt in the future decide to cut their dividend payments off completely for basically whatever reason they like. So just be careful and don't assume that you'll definitely get paid here. You can find loads of companies from big household names. I mean, just consider BT here in in the UK. They cut their dividends last year and the last part of 2020. They're back to being paid now, but if you relied on that cash, then you might have a bit of a rude awakening. And finally, something I've spoken about before in this channel, the dividend trap. This is something that can suck investors in and lose their money faster than a pyramid scheme for skincare products. This trap happens when investors see high dividend yields from a company. Remember that the dividend yield is the percentage of money that a company pays out in relation to the price of the share. So if you saw a 5% dividend yield, this would mean that you'd get a dividend payment of 5% for the year. So $100 share in the company would receive $5. Something like 3, 4, or 5% dividend yields can be quite common. However, sometimes you'll see dividend yields in the double digits and you'll think you've found some kind of infinite money glitch because you do the math in your head and you work out that you could get like 20% a year or something. You can basically beat Warren Buffett. However, just remember that although a dividend yield might show as being high for a short period of time, if it is too good to be true, it usually is. Often a dividend yield gets skewed for a couple of reasons. Sometimes the company can genuinely pay out special dividends or large one-off amounts, and this happened recently with companies in the mining sector because all of a sudden they made loads more money than they expected. But secondly, you might see a high yield but totally forget to look at the share price of the company and the actual direction that it's headed in. A good example is Altria. So if you didn't know this company, they own some of the biggest brands in the tobacco industry. The yield might look market beating and great returns, but then when you actually see the share price decline, they're pretty much giving you with one hand and then taking with the other. If the value of your shares go down more or the same as the dividend yield itself, then you're actually not making any money at all and actually heading in the wrong direction. So just be really, really careful. I think it's fair to say then that the answer to the question of whether or not dividend investing is good for beginners is, like most things in investing, it depends. On one hand, they offer a great incentive and give you real cash today to do with whatever you like, but on the other hand, the money could have been used to help grow the business or even buy back those companies' own shares. The good thing is that there's nothing stopping you from doing whatever you want. You can invest in some dividend stocks, some growth stocks, and some index funds. I mean, you can find whatever works for you, and you don't have to stick and choose to one specific kind of investing. At the end of the day, it's all up to you. Even holding index funds pays out dividends if you look at the S&P 500 as an example, so you can't really avoid them, but if you're smart with it and put them to good use, you'll end up doing really well in the long term. At the moment, with the market in a downturn, the dividend-paying stocks are probably going to be the ones who weather the storm and get through all of this, whereas the growth stocks with lots of debt and no free cash flow could be the ones in trouble, but who knows really. The most important thing is to understand what you're getting yourself into and find what works for you. Anyway, and on that note, if you want to check out any of my other videos, head over to my channel where I've done loads of videos aimed at investing for beginners. Otherwise, enjoy this next video, drop me a like on the way out, subscribe for many more, and as always, happy investing.
And have a lovely weekend.
Yeah!
Here we go.